Let's take a short interlude and maybe some caution around the idea of traders behaving badly. Okay, and like, what? People kind of try to scam each other? What? On the internet? Okay, yeah, it happens. And so we want to talk about one of the more common things you'll see out there, just so you're kind of ready for it and be prepared for it. And other things that are out there too. So one thing is government regulation. I'm not going to talk about politics where you like big government or small government, but government regulation is designed to protect us, at its core idea, especially in like the securities area. And the idea is that cryptocurrency is less regulated than other types of securities by far, but it's becoming more regulated all the time, and that helps us. That helps to protect us. Certainly having a certain amount of regulation helps protect us as regular, everyday people, as traders. One challenge with cryptocurrency is it's more lightly traded than other markets. Lightly traded means not as many transactions and that kind of stuff. So it's easier for somebody to maybe do a little gamification or manipulation with like cryptocurrency than like larger, big markets like the stock market, for example. Stock market can be vulnerable in things like low cost or penny stocks, but it's harder to manipulate somebody big like Apple or Tesla or whomever, Amazon, right? Because there's just so much trading volume happening on there. And the one thing that happens is that traders will post false things. What? Yes, they do. They'll post false things to try to raise the cryptocurrency price artificially, right? And then they're going to try to sell for a quick profit. So they're going to kind of do that. And we actually have a term for that, and I'm going to show you an example of that, and that's called pump and dump. And the idea of a pump and dump is it's kind of like a three-step process. First thing a trader behaving badly would do is they would buy early into something, right? They would buy early, in this example would be at, let's say, 0.10, and then they're going to really try to pump that, artificially pump up the price on that. They're going to send out blog posts or send out social media things saying, this is a hot tip, or the next big thing, is this cryptocurrency, and there's definitely a breakout coming. They're talking about technical analysis stuff. Look at the breakout. Look at this chart pattern. It's going to break out. Or they'll promote it on a forum or a blog or YouTube or Reddit or whatever it is to try to pump up that price, let's say up to the 0.90. And then the third step is they quietly, behind the scenes, while they're pumping, is they'll sell. They'll then sell at that 0.90. They'll get out, and they've made their profit while other people experience the loss as it kind of falls apart. And this is easier to do with lightly traded securities like cryptocurrencies. And even in the cryptocurrency world, things like Bitcoin or Ethereum, the big guys, a little harder to do with, but certainly with some lesser known alternative coins or altcoins or newer coins or initial coin offerings, or coins that have just come off an initial coin offering and might be lightly traded on a few exchanges, easier to manipulate that way with a pump and dump scheme. Things, as I mentioned before, like in the penny stocks in the stock market world. So this isn't just a cryptocurrency. It just seems to be a little more prevalent in cryptocurrency. And I think it's because, there's a lot more light trading on that. So it can be more impactful for the pump and dumper. One thing to kind of watch for is, watch for any really unexplained, very rapid rise in price, and be looking for these things if you're starting to see this kind of pumping going on. And also consider the source too. Who's doing it? Is it some kid in his basement or whatever? So consider the source as well. This is a real cryptocurrency chart. It is a real cryptocurrency chart. Actually, it's a time and period from Ripple, otherwise known as XRP. And there's a period here where I wonder if this was a pump and dump thing. If you look at this chart, do you see where there might be the pumping and where there might be the dumping, and how it led up to that? Let me throw a whole bunch of stuff on this chart, and let's walk through it. So you can kind of see what actually happens out there without a nice little animated graphic. So as you can see, these are the, let's say, hours. It could be days. Let's say this is actually days. And each of those candlesticks represents a day. Some are up in the green and some are down in the red. But you can see not much happening, where they're all kind of staying about the same. That blue line going across is a moving average line, by the way, where crosses above that would be a buy signal. So nothing much happening. So a pumper would buy one and not much is happening there, right? And then they would say, this is the greatest thing ever. This is going to be bigger than Ethereum. Oh my gosh, this is just so amazing. And then it starts to go up. And then let's say something happens, like it approaches or maybe starts to go past that moving average line. So they pump even harder. Oh, it's going past the moving average line. It's ready for a breakout. And then the next day you see the big long green arrow, a big green candle. It does break out, maybe artificially. And they're pumping real hard now, right? Like, oh my gosh, look at the prices are skyrocketing. If you don't get in now, it's a mistake. And then it goes up, that the day after a little bit more, right? A little bit of pullback, but it ends up finishing higher the day after that. And then if you see that red candle, you have that big, long, tall up wick, the wick up to the higher pair. That's showing the range of prices to the top end. And you can see that people were buying and selling really high up there in terms of the price range compared to where they started at. And they got real high up there. And that's where a lot of unfortunate people bought in at that real high part. And the pumpers are now dumping, right? They got it spiking up there. They've had a couple really good days in a row, and then had a spike, and they're like getting out, right? And meanwhile, people who are going to be victimized, they got bought up higher, and as you can see in the red candlestick, the bottom of the being body of the candlestick in a red candlestick is where it closed lower. So if you look at that big rectangle at the very bottom line, not the wick part of the bottom, but the bottom of that rectangle, that's the closing price. And you can see, wow, that came way down from what they might have bought it from just in that same day. So that's the idea of the scam, is you pump it up and you dump it there. And then you can see it starts going back towards that moving average line, and whatever happens afterwards happens. But the idea is a lot of people bought in very high, and it was all because of a scheme going on behind the scenes. So with that, just be aware of it. It's not super common, but if you see something like some kind of thing unusual going on, it probably is. And don't have that fear of missing out. Just really approach it from a technical analysis, from a tactical, unemotional standpoint, and you'll be fine. And it's better to be wrong and maybe miss out on something than be a victim of pumping and dumping, because that's where you can really lose quite a bit of money quickly. So just things to be aware of and evaluate. And now let's keep going and understand how we can be not traders behaving badly, but traders being successful, or successfully.